Great, thank you. Okay, so we're at topic 12, the final topic for this semester, and as you'll know from reading Milo, we're talking about financial literacy. And while this isn't the sexiest of topics, it is a super important topic for all of us to function well in society, and so it's something we include in this numeracy unit, just because, or partly because it's really it's an important part of being numerically literate, but also because it's a good example of some of the techniques that you've developed over the semester. So obviously, as you can imagine, questions to do with finance involve using percentages and fractions and all that kind of stuff, and some algebra. So that's what we're that's another reason for looking at this particular topic. And of course, the other reason is that these few statements here about the issues with financial literacy in society. So most people really aren't financially literate enough to be able to function well, and yet we know that so many of our decisions in our life revolve around our finances and how we're managing them. So it's a great skill to be able to have the knowledge and the confidence to make good financial decisions, and so that's part of being financially literate. So we're going to today just look at some really key financial concepts. So some of the really big main ones. We'll look at interest. We'll look at credit cards. In fact, we'll just look at credit card debt because that seems to be a big problem for a lot of people. And we'll look at tax because that's something we all have to pay. So if you've been on Milo, you'll know that for this topic, I decided to steal someone else's napkin finance graphics because I think they're kind of cool. They illustrate some of the main points, and I'm just going to flick through them fairly quickly because they're up on Milo for you to have a closer look at some point if you want to. The main thing about interest is that when we save, if we're in the fortunate position of having extra money, we can save it, and the idea behind saving it is to earn interest. So earning interest is about growing your money, making more from what you have. The general principle behind interest is it's the cost of using someone else's money. So when you save money in the bank, you put your money in the bank pays you in interest, and that payment is for the privilege of using your money to do something else. So banks tend to invest the money that people save with them in some other enterprises, and they ideally what they try to do is make more interest than they will be paying you. So that's how they're profitable. Of course, that's great if you're in a situation where you're saving interest, you're saving money. If you owe people money, then you're paying for the privilege of using someone else's money. So when you rack up a debt on your credit card, the interest that you pay on that loan, it's like a small loan, is the cost that you're paying for the privilege of using the bank's money. So that's what interest is. There are two kind of ways that interest is calculated. One's called simple interest, the other's called compound interest. So simple interest is just where you put your money in the bank, and after a period of time, the bank gives you a certain percentage of the money that you invested back in interest. Compound interest is like that process done over and over again, where in between you're investing the interest that you've earned again. So it's like you put some money in the bank pays you interest, and you add that interest back to the money that you started with, so that now you've got more money invested in the bank, and the next time the bank calculates interest, it's calculating it on the money that you started with plus the interest. So it's like earning interest on your interest. And the amazing thing about compound interest is that the rate at which your money increases, your savings increase, is exponential. So it's not, so that means it doesn't go in a straight line. It goes up like this curve. Let's see if I can draw on this slide. Okay, so this curve here is an exponential line. So you can see that you start off with not not too much of a difference, but then as time goes on, because there's more and more of your interest accruing, you get to this magic point where your savings are going up quite quickly. So that's the great, amazing thing about compound interest. To see how that plays out kind of over the long term, here's a little example. So the red area is where someone's just receiving simple interest, so it's not compounding. They're not earning interest on their interest. So the money that they're starting with, if you look at this, the blue area is their initial investment of $1,000, and so their initial investment of $1,000 with simple interest. Obviously, the amount of interest you get increases with the time that it's in the bank. So this bottom axis is the number of years, badly written graph without a scale, so years. And over time, of course, simple interest will grow, but not the same way that compound interest grows. So over the short term, like 2 to 5 years, there's not really much of a difference between how much interest someone gets from simple interest or compound interest. It might only be a few dollars, but over a longer period of time, compound interest takes off. And so you can see that after 20 years, the difference in interest, when that interest is calculated using the compound method, is huge. So at the end of 20 years, this person's, so 20 years is quite a long time to have money invested. Simple interest, they've earned $2,000 in simple interest, but their compound interest amount, it's actually this whole amount here, they've got $6,000 in compound interest over the same time period. So that's quite a significant difference. And that's one of the reasons why if you hear people talking about investing or adding money to your superannuation account. So if you're in the position of earning a bit of superannuation with your employment, the more money you put into your super account sooner, the more money you're going to have at the end when you retire because of compound interest. So it might only make a small difference in the short term, but in the long term, that extra investment of $50 a week is going to add up to a huge amount when you retire. So that's what that's about if you hear people talking about adding extra to your super. So here's another example of the difference it can make. So $10,000 invested for 40 years at 5% a year would grow to $30,000. But invested with compound interest, that same amount over the same time period would be more than twice as much, $70,000. Okay, what do the formulas look like? So the amount of interest that is earned for simple interest depends on how much you invest to start with. So that's P in this formula. Make my pen come back. All right, so P is the amount that you start with. R is the interest rate. So interest rates at the moment are quite low, but sometimes they're high, depends on all kinds of things, the financial state of the country. And T is the amount of time. So the more money you invest, the higher amount of interest you end up with. The higher the rate, the higher amount of interest, and also the longer the term. So if it's in for a longer time, you'd expect to get more interest back. Now, the important parts of using this formula are that the rate needs to be expressed as a decimal, whereas normally when you get an interest rate, it'll be given as a percentage, and the term needs to be given in the same unit. So if the rate is the percentage per year, then the term needs to be in years as well. If the rate is the percentage per month, then the term needs to be expressed in months. So those two things have to be the same. Okay, so quick calculation. You can have a go at doing this. How much interest are you going to earn on $1,500 invested for 5 years at a rate of 2% per year? The important thing here is to work out what each of the variables are. So we're working out what the interest is. So that's our thing that we're investigating. So we don't have a value for that. We've got the variable P. That is the principal. So that's the amount you start with, which is this. So that's P. The rate, okay, the rate is 2% per year. So we're going to do this in years, but we need to convert that as to a decimal. So R, you know how to convert a percentage to a decimal, is 0.02. And then T is the term in years because our rate is in years. So that's going to be our T5. Okay, so someone with a calculator can do this for us. I'll write down the working you should have. So you should have I equals 1500 times the rate, which is 0.02, times the term, which is 5. And what do we get? Where's my calculator? Is anyone still there?
Yep, 150.
150. Okay, thank you. So 150, and then remember to include a dollar sign because we're talking about a dollar amount. Any questions about that one? Are we all still good? All still good. Okay. Okay. All right. So that's a simple interest calculation. Simple interest is the easier of the two to calculate. The formula is simpler. Let's have a look at a compound interest question. So same amounts. Oh, there's the answer for the simple interest. Here's the compound interest question. So the formula for compound interest is a bit more complicated. What we've got is, we've still got our principal, which is P. We've still got the rate, but now the rate is an interest rate per compounding period. Now, what do I mean by that? So when we said that the bank calculates the interest on your interest plus your investment amount, it does that over a certain period. So it might do that every month, or it might be every 3 months, or it might be every 4 months, or it might be every 6 months, or it might be every year. And those things are called the compounding period. So if it reinvests it every 6 months, so that means it calculates your interest after 6 months, and then that money automatically gets reinvested with your principal, and then 6 months later the bank calculates the interest owed again based on your investment plus the interest that you got from the last 6 months period. That would be a 6-month compounding period. And so for this formula, to use this formula, you need to know what the compounding period is, and then you work out what the rate is per compounding period. But that's complicated by the fact that usually when you are given the interest from the bank and they tell you what the interest rate is, they tell you what the annual rate is. So you need to convert that to convert the annual rate into the rate per compounding period. So we'll do an example and that'll make it clearer. There's also the interest also depends on how often that happens or how many times that happens. So the number of compounding periods, or how long the investment is in the bank for, and how many compounding periods there are during that time frame. So, and the other thing to note is that, so the formula has the N up here is the indices. Remember indices, we talked about them. So to the power of N, so that's this number 1 plus R multiplied by itself N times. We're going to use your calculator or an online kind of calculator if your calculator doesn't have indices to work that out. And the other thing to notice with this formula is the A, that doesn't equal, that's not the same as I that we had in the simple interest formula. A is the amount that you end up with at the end, so it's the investment plus the interest. So if you want to work out how much interest you earned, we need to subtract away the initial investment. So we need to subtract the principal after we've done the calculation. All right, that all sounds way more complicated than it is. Let's have a look at the calculation. And what I want you to do is first just identify the variables. So reading through, it says, how much interest would you earn on $1,500? Okay, that tells us that's our principal. So I'm going to write that up here. So the principal is $1,500. That's how much we're starting off with. Invested for 5 years. Okay, keep that in your head for a moment. At a compound annual interest rate of 2%. Okay, but with interest compounding every 3 months. All right. So if the interest is compounding every 3 months and it's invested for 5 years, how many compounding periods are there? So when we're trying to work out N, how many compounding periods will there be in 5 years if it's compounding every 3 months? All right, so if it's compounding every 3 months, that's going to be, sorry, I'll just keep going for a moment. If it's compounding every 3 months, that means it's 4 times a year. Can everyone see that?
Yep.
So if we're compounding 4 times a year for 5 years, that means there's going to be 20 compounding periods. Okay, so every 3 months, under here, I'll just write down that means 4 times per year. And if it's 4 times per year for 5 years, over 5 years, that's going to be 20 compounding periods. And what about the interest rate per compounding period? So it's 2% per year, but it's going to do it 4 times. So we want it to, over the 4 compounding periods in total, that's going to add up to 2%. So what we need to do is divide by 4 to work out what the rate is per compounding period. So that's going to be 0.02, which is 2% turned into a decimal, divided by 4. Whatever that is. 0.005. Is that right? That looks right to me. Okay, does anyone have any questions about that? So you can see that the compound interest formula is a little bit more complicated than the simple interest formula because we have to work out 2 things that we're not given immediately. So we need to work out R, so the interest rate per compounding period, and we need to work out N, the number of compounding periods. Okay, I'll pause for a moment. Any questions?
How come it's not divided by 3? That's what I was thinking.
Okay, because it's per compounding period and there are 4 compounding periods in the year. So it's compounded every 3 months. But if you think about it, if it's going to be compounded every 3 months, here's my year. And so it's going to be compounded at the 3-month mark, at the 6-month mark, and at the 9-month mark. And then we're going to get it back at the 12-month mark. So there are 4 of those per year, and we want the interest rate to add up to 0.02 over the year. So 0.005 plus 0.005 plus 0.005 plus another 0.005, that's going to add up to 0.02 across the year. Does that kind of help?
Yep.
Yeah, okay. Any other questions? All right, so we've got that up our sleeve. I hope you've written those numbers down because I'm going to erase this slide now. Okay, no one yelled out at me, so I'll keep going so that I can flick to the next one. Okay, so here's the calculation that we're doing. So what I would suggest you do is you work out your variables like we did on the previous slide, then write down the formula with those values substituted in, but keep it like that for now. If you get that far and you just make a mess of putting it into your calculator, you'll get most of your marks because you've shown that you can identify what the amounts are for the variables and substitute them into the formula. And now it's just a matter of getting your calculator to behave the way you want it to behave. So what I'm going to do is show you how to do that. So most people don't have a well, most phones, I wonder if my phone has it. Have a look on your phone and see if it has a way for you to enter indices. So sometimes if you turn your phone horizontally, it'll give you a few more options. And on my phone, it looks like this. Don't know if you can so have a little look on your phone and see what you've got. What you want to be able to do is to put that into your calculator, but you might need to do it in a few steps. So you might need to go 0.02 divided by 4 first, 0.005, and then you might need to add that to 1. And then you should be able to use this little caret symbol. So on my phone, it goes 1.005, and then the little caret symbol, and then I can put in 20. And when I do that, I get 1.10489. And then I'm going to multiply that number by 1500, and I get 1657. Okay, so I'll leave you to kind of work out how you can do that on your phone. If you can't do it on your phone, then Google online calculator and find an online calculator that lets you put in indices. So that's what you need to be able to find. And you can talk to me at the end of workshop if you want a bit of help working a calculator. But remember that when we calculate this amount, A is the total, that's the total amount we have at the end of our 5 years, and that includes the amount we invested. So to work out the interest, you need to do one extra step and subtract away the principal, the amount you invested, and so you find that the interest earned in that period is $157, which isn't all that different to the amount we earned when it was calculated using simple interest. That was $150, so $7 difference over a 5-year period, but over a 20 or 30-year period, that would be there'd be quite a big difference. Okay, I'll pause and take any questions.
Pragati, can I just mention that on an iPhone, as you spin it to the side, the little button is a capital X and a small Y.
Okay.
That's the button on an iPhone for those that might be wondering. That's what we'll do that for you, rather than that little tiny pointer that you...
so you might get an X to the power of Y. So what you do is you type in your, depending on, I don't know, do you type in 1.005 and then the X to the Y button, and then 20? Yeah, and correct. Then hit equals, and that's an alternative. And I think if you look at an online calculator, you'd see something like that as well. Thank you.
Samsung my Samsung phone does the same thing as well when you go into the scientific calculator.
Yeah, cool. Okay, so there are options. It's really worthwhile investigating your own calculator and working out what works. So X to the Y, Windows 10, switch to scientific mode, Tim says. Okay, I don't know what that means, but you can elaborate in the chat if you want to. Okay. All right, yeah, so some people might need to bring up a scientific calculator on their phone to get that to work, or just use your computer. Any other questions? All right. Upper left sidebar is on the standby default. Okay. All right, let's continue. And so I think Tim's put some suggestions in the chat for people with other devices. Okay, so we're not going to calculate these, but I want you to, or in fact you can calculate them if you like, have a go at using the interest formulas and work out firstly what P, I, R and N are for each of them. So the simple interest as well as the compound interest, and then you can, if you can get your indices button to work, then you can actually do the calculation. But the main thing is to identify the variables. So I'll just give you a minute to work out. So I'll write down the formulas for you, and then you can work out what values we would plug in for each of them. So the simple interest one is this, and the compound interest one. Okay, first one's easy. Now, what do we think the compounding period is for the compound interest here? So if it doesn't tell you, you're going to assume that it's compounding every year. So they're not compounding it in between the year, they're just calculating it yearly. It says it's 5% per year, but remember that when you're given a compound interest rate, it'll almost always be per year. So like in the previous slide, it said 2% per year, but it also specified that it was compounding every 3 months. This just says 5% per year, doesn't tell us how often it's compounding. So we assume that it's compounding every year. So the compounding period in this is we're going to assume it's 1 year. That does make a difference. So if it was compounding every 6 months, we get a lot more interest than that. It's only compounding every year. All right. So we've got P. So what is R going to be? Well, it's the rate per year, which we've actually been given. So that's quite easy. So we've got R is going to be 0.05 again. And N, the number of times it's going to compound. Well, it's over 40 years. It's compounding every year. So our number of compounding periods is just 40. So here's what this formula looks like. A equals 10,000. 1 plus 0, oh, I made a mistake, 0.05 should have said. So 0.05 to the power of 40. Okay, all right, so just a moment for you to play with your calculator and see if you can get that number to work out. And notice that they've actually rounded it incorrectly, because when you do it on your calculator, you should get 0.88 at the end. And so that should be rounded to $70,400.
Thank you. I feel better now, I see that.
So they've rounded it incorrectly, $70,400. And so the interest, remember to always think back at what it is that you've calculated. When you're using the compound interest formula, you've calculated the interest plus the investment. So we need to subtract our investment amount away again. So let's subtract away the 10,000 that we started with. So with the compound interest method, our interest amount ends up being $60,400, whereas that's the interest. And with the simple interest amount, the interest is $20,000. So you can see that with the compound interest over 40 years, that's quite a significant difference between simple interest and compound interest. All right, pausing again to see if anyone has any questions.
I have one.
Yep.
The first one.
Yeah.
Every time I do it, I keep coming up with 20,000 as the answer, not 30,000.
So, no, it is 20,000, and you'll see I wrote that down here. What this amount, the amount that they've given you is how much your investment, like your investment plus your interest at the end of the 40 years is going to be 30,000, because you've got your $20,000 in interest plus the $10,000 you started with. So these two numbers are comparable. So $30,000 is what you end up with, including the amount you started with, or $70,400 if you're doing the compound way, or if you're just thinking about the amount of interest earned, it's these two figures here.
Okay.
Is that right?
Cool.
Okay.
Yep. Thank you.
Okay. Any other questions? Okay. All right. And there's some questions practicing calculating interest on Milo as well as on your worksheet. Now, there were a couple of questions on Milo that were mainly just intended to kind of shock you into never racking up a huge credit card debt. We weren't expecting you to actually calculate how long it's going to take someone to pay off their card. And that's partly because you don't have enough information to do it. Like, we don't know how often the bank compounds the interest that it charges you, and we don't know how they calculate the minimum repayment amount, and both of those things will affect how long it takes to pay off the card. So I'll fix the wording on Milo for that in case anyone was confused. So it was really just kind of have a guess. So if someone owes $2,000 on their card, they've got an interest rate of 18%, which is fairly typical for a credit card, and they decide not going to use the card anymore, going to just pay off the minimum amount that the bank tells me to do every month. How long is it going to take to pay off the card? And if you've had a look at Milo, you'll know that it actually will take 15 years, which is a huge amount of time to pay off $2,000 when they're not spending anymore. Okay, so that's really just a bit of a cautionary tale. When banks issue credit cards, they charge interest on the amount of money you've spent, and that interest is calculated with compound interest and at a very high rate. And so the amount of money people end up paying back in interest is often more than they actually owed on the card in the first place. Banks, of course, use that to their advantage because it means that they're getting quite a big payback on their little loan of $2,000 to you. So in particular, in this case, that $2,000 loan that's going to take Sasha 20 years to pay back, 15 years, more than 15 years to pay back.
Pragati, how come you think it takes 15 years when, I mean, it's calculated every month, everybody knows. Credit cards are calculated monthly with compound interest. The working out, can you at least show me that? Because twice in the information, you're asked to click a link to indicate what's right or wrong. And when you put those figures into a spreadsheet and work them out, it comes out at 7 years. So
I might talk to you about
perplexed.
Yeah, so can we talk about that after the workshop, because it's not really the core part of this unit. So
I'm just confused.
I'll put you on hold for that one if you don't mind. All right, and then also, by the way, so this quiz just comes from the ABC. There was an ABC kind of general financial literacy quiz a little while ago, and the link is on Milo, and you can go on there and just have a little test of your intuitions based on some of the things that you've learned here. And there's also some questions not related to what we're talking about, but again, it's quite interesting as a general kind of financial literacy quiz to see how you go. So ABC says it's going to take more than 15 years, and in that period of time, Sasha's actually going to be paying over $3,500 in interest on top of the $2,000 that she owes. So she owes $2,000 on her credit card because of compound interest, and over 15-year period of time, and with a huge interest rate, it's most likely going to cost her over $3,500 in interest. So that's a little example of compound interest at work, the way that a relatively small amount can, with quite a large interest rate, but over a longer period of time, can rack up quite a big amount of interest. And in this case, it works against Sasha because she's the one in debt. So the bank is making quite a bit of money in compound interest from Sasha. Okay, so that was just a little bit of a kind of like, oh yeah, don't do that, but an example of where compound interest can really make a difference. Credit card statements will often come with a statement like this. So if you have a credit card, they'll give you a closing balance, they'll give you a minimum repayment, and these days they're also required to provide some kind of statement that indicates that you'll be racking up a huge amount of interest if you only make the minimum repayment. So there's often a minimum repayment warning on the credit card statement, and in this particular case, the closing balance so this is how much is owed, $1,625 on this account, and the minimum repayment amount will of course change over time. So I don't know how the bank calculates the actual minimum repayment. That's going to vary from bank to bank, but the minimum repayment if this person only ever makes the minimum repayment, it's going to take them, this is the bank calculating this, 21 years and 7 months to pay it back. And over that time, they'll have paid $5,000 in interest. That's on top of the $1,600 that they owe. So $5,000 in interest on a $1,600 loan is ridiculous. It's a good reason to not just pay the minimum repayment. And the bank, in fact, has said that if instead this person chooses to pay $83.72, fairly random amount, but they pay that every month without using the card for any other expenses, it'll take them 2 years to pay it back. And in that period of time, they'll have paid $383 in interest, which is a whole lot less than $5,000 in interest. All right, so that's all we're going to talk about for credit card debt. Just get the basic concept in mind that credit cards rely on compound interest, and compound interest is the one that gets big quickly. Okay, tax. Last little topic for today, and the main thing is to be able to calculate tax. There's some, obviously you should know why we have to pay tax. It supports basically everything that we take for granted, and when we function in society, a lot of that comes from the tax money that we hand over to the government every year. We, taxpayers, people who earn an income, and in particular a big chunk of it goes towards education costs. Yes, it also pays politicians' salaries, but that's the part of their job is to provide all these other services that we take for granted. So yes, they get quite a large salary, but we won't say much about that. Where does the tax revenue comes from? Individuals' income tax. That's by and large the largest portion of tax revenue, but then there's also other kind of business related taxes that go towards the government's tax revenue, which then pays for our education system and our healthcare system and our roads and so on and so forth. Okay, so how is tax calculated? So again, a fairly quick look at how that works in Australia. So the tax that you pay depends on how much you earn. So we have in Australia something called the tax-free threshold, which in Australia is $18,200. So the first $18,200 that anyone earns is tax-free. You don't pay tax on that first amount of income. And then after that, the rate increases as you earn more. So the next kind of chunk of money that someone earns, so someone earns between $18,000 and $37,000, the first $18,000 is tax-free. The rest of it, they're paying 19 cents for each dollar over $18,200. So that's like saying the rate is 19% for the amount of money over $18,200 that they earn. If they earn more than that, so in the third tax bracket, this one here, then the rate goes higher. So it's 32.5% for each dollar over the $37,000 mark. So, and it goes up. So 37% for the next bracket and 45%, which is almost 50% for amounts over $180,000. And then on top of the tax that you pay based on your tax bracket, there's also the Medicare levy, which is 2% of your taxable income. So that's the whole lot. And there are exemptions and differences between people for the Medicare levy. So it depends a bit more on your specific circumstances, but for the sake of simplicity, we're just going to assume it's 2% for the rest of this topic. Any questions that I give you, just assume the Medicare levy is 2% of taxable income. All right, so that's how the tax brackets work, and they're fairly stable. Like this, the rates that you see in this table were the rates for 2018 to 2019, as well as for this last financial year, as well as for the next financial year. And I think 21 to 22, so that financial year, the rates are going to change. The brackets are changing a little bit and the rates are changing a little bit. But you get the general idea is that there's a certain amount of money that you don't pay tax on, and then you pay an increasing amount of tax on higher and higher amounts of income. Okay, so just some vocabulary. This isn't all the tax vocabulary that you'll need, but it's most of it. So in general, when we talk about income, we're talking about their gross income, which is their income before any taxes are taken into account and before any deductions are taken into account. So deductions are, they're called, I think the terminology I've used is taxable deductions, but they're also called allowable deductions, and that's for work-related expenses. So if you, it's money that you have to spend in order to be able to do your job. So if you have to buy a uniform, you have to dry clean your uniform, then those costs, you don't have to pay tax on them. So they get deducted from your gross income, and that's how your taxable income is calculated. So your taxable income is the one that you decide which bracket, we decide which bracket that falls in, and that's the amount, your kind of amount that you get, the gross income, but minus any eligible deductions, so taxable deductions. And then the other bit of terminology that's relevant is your employer. Employers are required to withhold tax and pay that to the government kind of as the year goes through. And so that's called pay-as-you-go withholdings. Or tax withheld, and that's the amount of tax that your employer has really already paid in tax on your behalf. When your tax bill is calculated at the end of the financial year, the government also pays attention to how much they've already received from you in terms of pay-as-you-go withholdings, and then works out how much you owe. So any questions about those bits of terminology?
I'm good.
Good. All right, let's keep going. So calculating with those values. So find the tax that Sue should pay on earnings of $28,514. So remember, when I say on earnings, I'm always talking about her gross income. Or in fact, if it doesn't say anything about deductions, then it's her taxable income, but we'll just get to that. But so this is her gross income. Pen work, okay. So to find her taxable income, you need to work out if she has any taxable deductions. If it doesn't say anything about taxable deductions, assume that it's also her taxable income. So it doesn't say anything about any taxable deductions she wants to make. So we're going to assume this is also her taxable income, and we're going to work out how much tax she owes on that amount of money. Now, and we also have some information about her pay-as-you-go withholdings. So she's already paid some tax, or her employer has paid some tax on her behalf. So we're just going to try to work out whether she's going to get a refund or whether she owes a little bit of money. So how do we do this? How do we use this table? Well, the first thing is to work out, so you calculate the taxable income first, which we've got because there are no deductions. Work out which tax bracket she sits in. So she earns $28,514, so she's in this bracket here. And then use this formula. So this is a formula, even though it doesn't look like a formula, but use that to work out what her tax due is. So how does that work? It's 19 cents for every dollar over 18,200. So we need to work out how many dollars over 18,200 she spends, and then it's 19%, or 19 cents for each dollar. So remember, 19 cents for each dollar is just 19% of that. So that looks like this. 19% of, remember, of is just multiplication, of $18,200 for each dollar over. So 28,514 is how much she earns, but then we're going to subtract the first 18,200, and she doesn't pay tax on that. She just pays 19% of the amount that's left over. So that's her, that's how much tax she pays. We're also going to work out her Medicare levy, of course, so you're always going to calculate the Medicare levy as well. So let's do that too, and then we're going to add those two amounts together. So the Medicare levy is 2% of her taxable income. Her taxable income is this amount here. So we want 2% of that. So it's going to be 2% of 28,514. So those are the two amounts we need. We need her Medicare tax, her Medicare levy, and we need the tax based on her income based on the bracket that she's in. Okay, so that's coming on the next slide. Is everyone happy for me to delete this slide?
Yeah.
Yep. Okay, here we go. So clear that slide and All right. So we were trying to work out how much tax she owes. We need the Medicare levy, we need her total tax, and then work out what her tax bill is based on her pay-as-you-go installments. Okay, so you can do that alongside me if you like. I'm going to write down some of your working, and I encourage you to get out your calculators and see if you can get these numbers. And just a warning, it's really important that you put the brackets in on your calculator or do it bit by bit because of BODMAS. So we talked about BODMAS before. If you go 0.19 times 28514 minus 18200, it's going to do the multiplication first, and that's not what you want in this case. So you need to do the subtraction first. So that's her tax there, but we're going to add her Medicare levy. Okay, pause there and you can check that you're right so far. Okay, any questions so far?
I'm still writing it down.
Oh, okay, I'll give you another minute. But do you see how like, can you see that you'll be able to do this?
I hope so.
Yeah, I reckon you will. Hey, you disappeared on me last week. I told you to wait behind so that I could do some more algebra with you, and then you were gone. Was it last week or the week before?
Wait, with me?
Yeah. Never mind, never
That.
mind. All right. Okay, so did everyone else get the same as me? Did anyone guess it? Okay, Tim did. Anyone else? So we all good? Okay, let's have some thumbs up or something so that I know that people can still hear me and that you're still with me. Thank you. All right, awesome. Okay. Yeah, okay, and there would be rounding. In fact, back in the old days when you didn't fill in, when you didn't do it online and you did it on paper, you filled in your tax, you were told you weren't even told to round, you just kind of got rid of the cent amount. So if anyone remembers that, that was a long time ago. All right, so her tax bill. Okay, so this is how much she owes in tax for the year, 2,500, and let's just call it 2,530. She's paid $40 per week in pay-as-you-go installments. So she's already paid, the government's already received from her 52 times 40, which equals 2,080. 2,080. So she owes the difference. Okay, so she owes 2,529, 25. I'm just going to write 2,530. 2,530 minus 2,080. Which is $450. So that's how much you'll owe at the end of the financial year. So of course you don't actually have to do these calculations when a tax time comes around, because the government does it for you. But I think just in terms of being aware of how your salary makes a difference to your tax level and how the pay-as-you-go installments work, I think it's really instructive to know at least this much about how the government calculates your tax. Okay, so let's so that's the end of what I wanted to talk to you about in terms of this week's topic. So we've looked at interest, compound interest, simple interest. We've looked a little bit at credit card debt, and we've done some tax calculations. And there's more practice of those on your worksheets for this week. Final little thing, so that's kind of the end of what I wanted to do with you today. There's some information on Milo for you to have a look at if you're considering doing more maths. So depending on what your future study plans are, you may need to do some more maths, and so there's some information there about how the maths program works at this university, as well as if you are planning to do bridging maths next semester, some information about how you can prepare for that unit. So it would be, if you are thinking of doing bridging maths, it'd be a really good idea to do a little bit of preparation over the break. So do a bit of study, and there are some links to some Khan Academy lessons on a attachment on Milo in case you are interested in doing more maths. So that's an option for you. And the other thing I want to indicate is this thing here. So this is a resource. So this thing, UTAS Maths Pathways, the link's on Milo. It's a resource that was put together to help people who are on specific pathways. So if they're going into education or to business or engineering, health, I think there are a few different options. So it doesn't cover all the pathways, but it has a few of the major ones. And it's got maths that's specific to those pathways. And the great thing about it is there's a little pre-test. So you can hop on there and do the pre-test, which tells you which areas of maths you need to spend a bit more time working on before you start on that pathway. So if you're in education, I know we have some education students, it'd be worth hopping on there and having a little look. And then if there are areas that the test identifies, so the test is, no one else is looking at your results, so it's just something that you can do on there for your own benefit, and it points out areas that you might need to work on a bit more. And then there are resources on that website, so on that Pathways website, to help you develop those skills. So it's a useful kind of, if you're not sure where to start in terms of what else you need to know for the pathway that you're on, it's a good place to go to see what they think you need to do in order to be ready for an education degree or a nursing degree or whatever else. So that's available to you. And then the last thing I'll say, of course, is another reminder, please do your Evaluate survey for all of your units, but especially for mine. Sorry, I'm messing around with this screen. It's not doing what I want it to do. Here we go. Won't take you for too long to do, and I'd really appreciate some feedback from you, just so that we can make all of our units, in fact, as good as they can be for future semesters. There's a little maths joke on this slide. Took me a while to get it, but you'll get it eventually. We haven't talked much about it, so if you don't get it, that's okay. I can explain it to you later. Let's have, I'm going to stop the sharing, and if you don't mind turning on your cameras for a few moments now for the last, so that I can say goodbye to you and actually see your faces while I'm doing that. So that's the end of this unit, really. You've just got, a tute left and a worksheet. If you have any, so we're getting to, obviously you've got lots of assessments for lots of other units and things. If at the end of semester you have any questions about your grades, or even if after you get your grade you go, oh, that's really not what I was thinking I was sitting in line for, please follow up with your tutors or your unit coordinators, because sometimes people make mistakes, and we don't always spot them, even though we check and we check and we check. Sometimes things slip through that no one's noticed. So if you get your grade and you go, oh, that's really not what I thought I was going to get based on everything else for any of your units, then follow up, go back to your unit coordinator and say, can someone just go through with me, why I got this grade, because I don't really get it. that's a perfectly legitimate thing to do, and no one else is going to advocate for you in that way. So it's really got to be your job to check your final grades and make sure that they gel with what you're expecting. So yeah, that's really it for this semester. So does anyone have any final questions or anything for me?
You go, it's okay.
You
I
go.
just want to say thank you.
Okay, Haben and then Liana.
Oh,
Ah,
okay.
okay. I just want to say thank you. It was enjoyable to learn with you.
Oh, good. Thank
yeah.
you, Haben. Yeah, awesome.
I'm thinking
Liana?
to go to learn this last tutor with you if it's okay, because my tutor is today and I have something to do. So is that okay if I?
Yeah. So email me and I'll send you the link.
Thank you.
Okay. Liana?
Yeah, well, this question is probably for like anyone considering doing bridging maths after this. How hard is it compared to this?
Okay. So how many people here are actually thinking of doing bridging maths? Let's get a little thumb show. Okay, so a few of you. All right. So Jane teaches that class. Most of you will know Jane Stratton. And the first week is really just revision of some basic foundational things. So she will assume that you are excellent at fractions, decimals, percentages, BODMAS. Those are the kind of the main things that she'll assume that you're good with those things. And in week two and onwards is basically algebra. Not algebra the way we've done it, although what we've done will be hugely helpful to you because it's the foundation of how it's what you've got from me is how a formula is built up, and that's what you need in order to be able to do anything algebraic. So if you've got that under your belt, that's a really great place to start from. But that said, it goes really, really quickly. So she goes and people kind of go, they do they do week 2 and they go, I'm not going to cope, this is really, really hard. And then they do week 3 and it's like there's more, but it's just the same. It's still algebra, but there's just kind of it's a little bit more. And then in week 4 they're still panicking, and week 5, and then by week 6 or 7, those people who've stuck it out, they kind of go, this isn't too bad, I feel like I'm getting it. And then they look back at what they were doing in week 2 and 3 and they go, that was really easy. What was I stressed about then? So it's one of those units where everything builds on each other. But that said, she gives you a lot of resources and a lot of help to get there. So you are expected to do quite a bit of work outside of class, especially if your maths background is not particularly strong. So it's really, if you think about it, it's a 13-week unit. And she's covering most of the maths that most students would do kind of up through year 9, year 10 level maths. So depending on where you're starting, if you don't really remember much maths beyond year 7, then you're doing 3 years worth of maths in 13 weeks. Right. So that's so it's a fast-paced unit, but if you spend a little bit of time over the break preparing, so you do some algebra work, and there are links on Milo for where to go to get that, then when you see it with Jane, it won't be the first time you're seeing it, and you'll kind of feel a little bit ahead of the game at the beginning, which is really good, because then by the time things get really hard, you'll kind of be going, oh yeah, okay, I can do this, I'm here now, and you'll kind of be over the hard bit. So anyway, the more preparation you do over the break, the easier you're going to find that semester. And you do have quite a decent length break, really, for most of you. If you're not working full time, then you've got till, mid-July or something? Semester goes back halfway through the school holidays, if you happen to know when that is. So you've got 1 week of school holidays with your kids, and then you're back at uni in the next week. So it's almost a month, really. And most of you don't have exams this semester, so you've really just got your final bits of assessment that are mostly due this week, and then you've got quite a few weeks when you don't have any formal study to do. So that would be a really good time to just kind of set yourself up with a bit of a routine and work through the maths. And if you need help, like if you're going through it and you get really stuck, then just email me or email Jane, and both of us will be happy to point you in the right direction. So I'd be really, in fact, email me because Jane's probably busy. But if you're kind of going through it and you're going, I don't get this bit, then just send me an email and I'll set up a meeting with you and we can talk through it. So I'm happy to help you get ready for Jane's class if that's where you're headed. But just be warned that it's quite a different, so it's very much a traditional maths class, unlike this one, and it's quite fast paced.
Yeah, good. Well, that's kind of what I wanted to feel out, is how it differs from this one. And
yeah, traditional maths. So think about high school maths on speed.
Oh, all right.
Yeah.
I've done high school maths already.
yeah. With a big focus on algebra. So
yeah, good to know. No, that's really helpful. Thank you.
Okay, cool. Any other questions?
Are we going to get our results for last week's worksheet soon?
Yeah, but it's not soon. It's going to take a little while. So it depends on, worksheet, Hobart students, so tutors are in charge of doing all the marking, and I think worksheet 10 has already been released, the marks, and worksheet 11 will probably take us a little bit longer to mark because it obviously took you guys a little bit longer to do. So there was a bit more writing, so it's going to take a little bit longer. So I would allow 2 weeks for worksheet 11, worksheet 12 about a week, but we're all kind of at that time of semester where we're trying to do 10,000 things. So in general, you should allow 2 weeks for a turnaround for worksheet marks as well, but we've tried so far to get them to you a bit quicker in the lead up. I have to say though, we changed the assessment this semester as well, but in that change, the intention was always to only give you, to not give you marks for individual worksheets. It was all going to be kind of part of a portfolio mark that you're going to get at the end of semester. And then we kind of, due to various factors, ended up giving you marks along the way, which has actually put a lot of pressure on tutors to be really timely with your marking. And so that's been quite a struggle. And of course, it all kind of went a little bit pear-shaped in the middle when we suddenly found ourselves all scrambling to get online. So that's why we're a bit slow with worksheets 3 and 5. But the idea was to give you some feedback on worksheet 1 so that you could do a good assignment, and then to just give you kind of a portfolio mark at the end of semester, because all the answers are actually on Milo. So if you want to know how you went on a worksheet, you can always hop onto Milo and see the answers. So the idea was for you to kind of use the answers to self-mark, and we were just going to give you 1 mark at the end for your portfolio, which we changed, and we'll probably, I don't know, we're still thinking about how we do it next semester. We probably will continue, because I think it is useful to get those marks along the way. But at the same time, it was never supposed to be, it's a lot of marking for tutors, and so we don't give you much feedback for the worksheets just because the answers are on Milo. So we're kind of saying, here's what we gave you, but go look on Milo and you'll see where you went wrong, or you'll see what you did right. And that was the intention behind the worksheets. So I don't know, we're still tinkering with that and how to do that. But I know that for some of your other units, you haven't really been asked to submit very much at all yet, and you won't be submitting much until the end, but you are supposed to have done the work along the way and then you won't get a mark for that until, probably until you get pretty close to getting your final grade. So I think the way this program is working is moving towards everyone kind of having a portfolio, so working regularly during the semester, being able to check to see how you're going by looking at answers and things, but not actually getting much by way of feedback till the end of semester, which I think is, or personal feedback. You get feedback by looking at the answers, but personal feedback on your actual work, I think that's something that you'll find you'll get less and less of as you go through your degree. You might just have 2 essays that you have to do, and you might not get your feedback for your first essay until 4 weeks after you've done it, and your final essay won't be due till the end of semester, and so you won't get feedback on that until you get your final grade.
Pragati, can I just say that this, I understand that you've drafted this particular subject, or you're responsible for the coordination of it, and it's been a really great introduction. I've only begun the UPP, and I have just found this subject really interesting, very diverse. It's really covered a lot of areas that certainly I haven't been for 25 years since I was at school. But I really appreciated once you began giving us a bit of feedback, because we're only learners and new to this whole university process for many of us, just getting a bit of feedback. I mean, it was one thing to look at your answers that you were giving on the worksheets, still trying to determine, because it was still a bit interpretable, those first 5 worksheets. It wasn't necessarily clear if we'd given a direct answer compared to what you'd shared. So it was really helpful once James started giving us feedback on where our marks were really sitting, because then we knew where we were going for the next assignment.
And I think that's the tension for us, is giving you guys feedback so that you can, you know, actually know where you're standing, but also not taking up too much of tutors' time in providing that feedback. That's really hard, because we want tutors to have the time to you know, to answer emails and to do all of the other stuff that they do. And marking every week is actually really hard for most tutors. Like, most tutors only work part-time. I only work part-time, and it's actually quite hard to find the time to mark every week. So yeah, it's kind of it's a trade-off. It's never going to be perfect, and we'll just aim for we always aim to give you as much feedback as we can, but has to be within limits. And at some point we just have to say, here's your mark, there's the answers, and if you have any questions, then email your tutor. And you know, not everyone even reads the feedback that they get, surprisingly enough. But for those of you who want more than we give you written, then there's always the invitation to get in touch personally. And it's much easier to have a 5-minute conversation with a student than to spend a lot of time putting detailed feedback on everyone's work, knowing that most people aren't going to read it. Yeah, cool. All right. Any other questions or comments?
Pragati, this was the most organised and easy to follow unit that we have had, or that I have had, I should say.
Awesome. Thank you. Put it in your evaluate.
I did.
Oh, good.
I would agree, especially in comparison to something like Introduction to Academic Writing, which is like, oh, okay, cool. I guess I think I know what I'm doing.
Yeah.
Bye.
Look, I mean, that's what the evaluates are for, like, really, for all of your subjects. This is your chance to kind of shape how things move for next semester. So, although sometimes we don't get the evaluate reports until we've already started the semester, but still, the more feedback we get, the better position we are in to make good decisions for future semesters. All right, well, I might say goodbye now, and thank you all for sticking with it and putting up with all of the stuff that went on in the middle of semester. I think you're all champions for even getting to the end of semester, because I know it's been really hard. And I appreciate how well you've engaged with this unit. It's been really nice to see your faces every week. So hopefully we'll all be back on campus at some point, and we'll bump into each other, and you can say hi to me, and I'll remember you, because I remember all of my students pretty much. But good luck with your next semester, whatever it is. And yeah, always feel free to keep in touch. So if there's anything that kind of comes up and you kind of go, oh, can you point me to something on Khan Academy that can help me with this, then just send me an email and I'll help you get sorted for that, even if you're not doing bridging maths or anything. So farewell. Don't forget your final tutorial worksheet. If you didn't do last week's tutorial worksheet yet, that box is still open in recognition of the fact that it was a slightly longer or more involved worksheet for people to complete. So you've still got till Friday for that. Friday's the absolute cutoff for that one. And the current worksheet's due on Sunday, but if you need an extra couple of days because it's the end of semester, then just send me an email and I'll reopen the box for you. I'll see you in Tute if you have me in your Tute tomorrow, and otherwise good luck, and get yourself organised and get the semester over and have a really good break.
Thank you so much.
Okay, bye everyone.
Bye.
Stick around for a question.
Yeah, sure. Yeah, if you have questions, stick around. Absolutely.
Thanks, Pragati. Just on the worksheet, I just wanted a quick question on there's a formula to be made.
Oh, you're frozen. Sorry, Teeny.
Oh, can you hear me?
Yeah. Yes, I can hear you now. Okay, go.
Can you hear me? Yep. Sorry about that. On the, which one is it down here? It's a Medicare formula that write down a general formula for